Hello, Jason Bates here, owner of Electrum Financial, a mortgage broker located right here in beautiful Cave Creek, Arizona, where a mortgage is not a flip of the coin. So if you're looking to purchase or need to refinance, I would like to be your broker of choice as I have access to the lowest rates at the lowest cost in Arizona. And if you don't believe me, call me. At some point during the mortgage process, the contract interest rate, the one that ends up on the note agreement, which is the document that stipulates the terms of the repayment, must be locked. This means that there is an agreement between you and the lender regarding the contract, what the contract rate will be. The rate lock will also specify a date by which the mortgage must close by and fund by. Rate lock timeframes can vary. Historically, the most common timeframe is 30 days. The recent surge in refinance activity has caused slightly longer turn times for various steps in the mortgage process, resulting in an increased lock terms of 40 to 60-day lock times. There continue to be shorter and longer lock timeframes as well, depending on the lender and a few other factors. Lock terms can be, but are not limited to, 10, 15, 21, 90 days, and even up to 6 months for those who are purchasing a new build. In some scenarios or among certain lenders, you don't have any input as to when or how long the rate will be locked. You may either agree to the lender's lock policy or take your business elsewhere. In most cases, however, there is a certain degree of liberty when it comes to choosing when and for how long to lock. In those cases, your mortgage professional will help manage expectations as to how quickly the process can be completed, with a general understanding and goal being to set a lock window that leaves plenty of time for the loan to fund and isn't unnecessarily long. Now, the reason is the longer the lock window, the higher the cost. When it comes to a mortgage process, costs associated with your rate can take the form of changes to the rate itself or changes to the upfront costs, discount, or rebate associated with that rate. Locking the same rate for longer means that the discount cost will be higher or the rebate will be lower. The relationship between the days of lock and the time and cost isn't always exactly linear, so it can make sense to weigh the risk and reward of various timeframes. The reason the cost is higher for a longer lock period is because when you lock your loan, it simply means that you have reserved your loan for funding. The lender still has to deliver the loan with the agreed upon terms to the secondary market. So in short, the loan is not locked for the lender until they deliver your loan to be securitized. That means once your loan is locked, the lender then assumes the risk of rates changing dramatically during your lock period. This is one of the reasons why lenders change the rates daily, sometimes multiple times a day, so they can keep their hedge margins in line with what the market is doing. There's no universally correct answer to the question, should I lock or float? It's one of the most thought-provoking and complex topics in the world of mortgage origination. There are too many variables for one approach to be applicable to every scenario. It goes without saying that locking in as early as possible in the process will always be the safest option for you. It's also unequivocally true that it's historically the least profitable option for any average day from 1980 on. That said, this is only the case because interest rates have generally been moving lower since 1980. Hard to believe, I know, but it's true. Not only that, but there have also been many times since 1980 when rates have risen brutally in spite of longer-term trend. In many of those cases, borrowers that failed to lock in early enough in the process were either forced to accept a higher rate or simply never completed the process. Now, when I talk about never completing the process, this could naturally be a very big problem in some cases. For example, rates can rise quickly enough that you may no longer qualify for the monthly payment. If not locked, you simply cannot complete the mortgage. In the case of a purchase, that could mean that you just lost your earnest money deposit, not to mention the opportunity to buy the house that you wanted or needed. Even in the case of a refinance, failing to complete the mortgage can mean the loss of significantly monthly savings or, in more dire cases, much needed cash for any number of purposes. Because of these potential pitfalls, it's almost universally wise to heavily consider locking as soon as the monthly payment and lock time frame makes sense for your scenario and to only forego locking if you're prepared for the increased costs associated with an unforeseen rise in rates. If such a rate rise were to jeopardize the qualification for the mortgage or even your willingness to complete it, locking is the only option. Now, despite the best of intentions and diligent participation among all parties, some situations are destined to run past their initial lock time frame. While there's no universal policy, most lenders are able to extend the lock time frame based on certain conditions. Most of the time, this will involve a predetermined cost, and in many cases, this is simply the difference between the cost of your original lock time frame and the next tier. For example, if there was an 8% change in the discount point in order to lock for 45 days instead of 30 days, and assuming you locked for 30 days only to find out it wasn't going to be long enough near the end of the process, extending to the 45-day lock could be as simple as adding the 8% to your upfront costs in order to extend the lock for the extra 15 days. In other cases, and depending on the lender, the situation can be far more severe, especially if rates have moved significantly higher since you first locked. It can absolutely be the case that going over the original agreed upon lock time frame means that your loan will now have worst case pricing. This means that you have to pay whichever is higher between the original cost of the lock time frame needed to complete the loan or the current market rate. If we're only talking about something like an 8% from the previous example, that's really not a big deal. But if rates had moved significantly higher, that cost could easily be over 1%. Enough to make anyone wish they had chosen the longer lock window period up front. In a rising rate environment such as we are in currently, it can get expensive really quick. So I hope this helps you better understand the rate lock process and the components that make it up. If you'd like to know more, please reach out to me. I certainly would like to meet you, and I just don't say that. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I would like to be your broker of choice. Until next time, take care and stay safe.